Welcome to the Deep Dive. We're jumping straight in today, tackling a really comprehensive piece of source material.
Yeah, an enduring business analysis focused entirely on Uber Technologies, ticker UBER.
And our mission, yours and mine, is really to cut through the noise of this detailed analysis.
Right. Pull out the most important insights, help you really understand the Uber business, not just, what it does, but how it works, where it might be going.
And explore the different perspectives, too, especially the tough challenges and risks it faces.
Think of it like your shortcut to getting smart on UBR, distilled from everything this analysis covers.
The core business, its competitive advantages, the moat management, financials, and that all-important future outlook.
It's a lot to digest, but that's why we're here.
Exactly. Let's get right into the core of what this analysis found.
Okay,
so let's unpack this. At its heart, what is Uber's business model today? Is it still just about rides, like when they first started?
Well, it's evolved significantly. The analysis describes it as fundamentally a technology-driven, multi-sided marketplace.
Right.
And the absolutely crucial point it hammers home is that it's asset-light. They don't own the cars. They don't own the restaurant.
They own the software, the connection layer.
Exactly. The digital platform that connects service providers, drivers, couriers with consumers who need a ride or delivery.
So they make their money primarily through that commission, right? The take rate.
Yeah, the take rate, which the source says is typically, 15% to 30% on the gross bookings, the total value.
That's the main engine.
That's the engine, yeah. But they've smartly added other revenue streams on top.
Like surge pricing. The dynamic pricing we all know when it's busy.
Or maybe dread, yeah. Precisely. That surge mechanism, it's pretty brilliant, actually. It balances supply and demand in real time and captures extra revenue.
And then there are things like Uber Black, premium tiers.
Right. And their growing subscription service, Uber One, plus various fees, cancellation fees, things like that.
Okay. And looking at how they report their business, the segments really tell that story of evolution, don't they? You've got mobility, delivery, and freight.
Right. Mobility is the classic ride-hailing business, still the biggest piece. And now, interestingly, its main profit driver.
And delivery.
That's the massive Uber Eats business, which has expanded, into grocery, alcohol, lots more.
And freight is the logistics platform, still finding its way.
Yeah, still in earlier stages compared to the others.
And the numbers the source provides for gross bookings, looking at FY 2022 through 2024, they really illustrate this perfectly.
They do. Mobility went from $51.8 billion to $85.6 billion. Huge growth.
Delivery also surged. $55.8 billion to $72.6 billion.
Yeah, massive scale there. Freight, interestingly, actually pulled back a bit. $7.8 billion down to $4.6 billion.
But the profitability data, the adjusted EBITDA, that's where you see the real shift, isn't it?
Absolutely. Mobility's profits soared, $3.3 billion, up to $6.7 billion in that same time frame.
Wow. And delivery
went from just $373 million barely profitable to a really substantial $2.5 billion.
While freight stayed slightly negative.
Right.
So this data isn't just numbers, it's telling a story.
It is. Mobility. Resilient, incredibly profitable now. Delivery. Huge scale. Now a major profit contributor. Freight. Still, figuring itself out.
And what the analysis emphasizes is that Uber isn't just moving people anymore.
No, it's about building these incredibly efficient, localized, three-sided marketplaces, providers, consumers, and now increasingly merchants, advertisers.
Right. This concept of platform optionality you mentioned.
Exactly. The potential to apply this model to, almost any kind of local commerce in the future. That's the big idea.
And it taps into really fundamental human behaviors, right? Convenience, speed,
efficiency. Plus, it's riding these big global trends like urbanization, the whole on-demand economy. These are tailwinds.
Yeah. But the analysis notes a double edge here. Its simplicity makes it easy to grasp.
But maybe, theoretically, easy to replicate.
Which means defensibility relies entirely on scale and execution.
Right. Which leads us directly to its economic moat.
Ah, the moat. Okay, this analysis really highlights that Uber's main advantage, its primary moat, isn't maybe what you'd first think.
Yeah, it's not some secret tech or just vague global scale.
What is it then?
It's a powerful two-sided network effect. But, and this is critical, it's localized. It's about density in each city. They operate in over 10,000 cities, but the effect is city by city.
Okay, walk me through that localized network effect again, that virtuous cycle. So more consumers using Uber in, say, London.
Means more earning potential, which pulls more drivers onto the platform in London.
Got it. And more drivers on the road there means
Shorter wait times, better reliability for those London consumers.
which makes Uber the most convenient option, bringing even more consumers onto the app.
Exactly. It feeds itself. And the self-reinforcing loop, it creates a really formidable barrier to entry.
So a competitor can't just show up in London and sign up users.
No, they need to build both sides, users and drivers, simultaneously in that specific city, just to get close to matching the efficiency, the liquidity that Uber already has.
The analysis gives that great relatable example, the business traveler at Chicago O'Hare Airport.
Right. They open Uber, see a 3-minute wait, maybe $45. They check Lyft or another competitor.
Maybe it's a 12-minute wait, similar price.
Yeah. And if time matters, the choice is kind of obvious, right? They pick Uber.
And that single decision, multiplied millions of times a day across thousands of cities,
Channels the demand, channels the earnings consistently towards Uber's network.
making it the logical place for drivers to be too.
It reinforces the whole thing. The analysis says it perfectly. The liquidity is the product. That availability, that short wait time, that's what people are buying. It's a non-monetary value that's really tough for others to match.
And looking at the U.S. market share data provided in the source, that localized effect seems to be making the moat even wider in mobility, right?
Yeah, the numbers are pretty clear. Uber's ride-hailing share grew from 71% in 2018 to 76% in 2024.
While Lyft's share dropped from 29% down to 24%.
That divergence is pretty compelling evidence. The moat seems to be strengthening in their core business.
What about delivery? Uber Eats.
There, Uber Eats is a strong number two, holding steady around 26% share. But DoorDash has really pulled away now, over 60%. So it's stable for Uber, but not expanding its lead like in mobility.
Now, the common critique you always hear is, well, switching costs are low.
Right. Anyone can just have both apps on their phone, right? Drivers can drive for both. Users can check both.
So how does the analysis respond to that?
It uses that market share data, particularly in mobility, to kind of push back. If it were purely a commodity business with zero switching costs, you'd expect more volatile shares, maybe closer to 50-50.
That's not happening.
No. The fact that Uber is steadily gaining share suggests there's a real, even if it's non-monetary, cost to using the smaller network.
The cost of inconvenience, uncertainty, longer waits.
Exactly. That superior liquidity creates sticky users and drivers, even if they could switch easily.
Okay, here's where it gets really interesting, and arguably unique to Uber. This cross-platform network effect between rides and delivery.
Absolutely. This is a big one. They're the only player at scale in their core Western markets with leading platforms in both mobility and delivery.
How does that help?
Well, think about the drivers. They can toggle between ride requests and delivery orders, optimize their earnings throughout the day, fill downtime. It's like a fungible supply across two huge markets.
That makes sense. More flexibility, potentially higher earnings for them.
Right. And for consumers, that ties into Uber One, the subscription.
Bundling the benefits.
Exactly. Offering discounts or perks across both rides and eats makes that subscription way more valuable. It increases user stickiness, boosts their lifetime value. The analysis identifies this cross-platform synergy as a distinct and potentially widening source of competitive advantage that others just don't have.
Okay, let's shift gears a bit. Talk about the Scuttlebutt view from the source. What people actually, using the service or working for the company think on the ground level.
Right. So for customers, the sentiment described is more about like functional utility and tolerance, not really genuine love or passion.
People use it because it works.
Pretty much. It's convenient, it's generally reliable, the app interface is good. The analysis mentions a 2024 study comparing Uber and Grab, where Uber actually scored higher on technical aspects and service execution.
But it's not a brand people are fiercely loyal to.
Doesn't seem like it. Common complaints are still there. Pricing issues, surge costs hitting hard, sometimes frustrating customer support experiences, feeling automated.
So it's seen as a useful tool, maybe a necessary evil sometimes.
Kind of, yeah. It's clearly sufficient to build a massive business on, but it doesn't suggest deep loyalty or significant pricing power beyond what that network effect provides.
Okay, and employee sentiment. The analysis points to a pretty stark contrast here.
It really does. For the corporate employees, especially since the leadership change back in 2017.
With Dara Khosrowshahi taking over.
Right. Since then, the sentiment is described as overwhelmingly positive. The source cites data like 92% positive reviews on comparably, people praising colleagues, the learning opportunities, pay, collaborative culture, supportive leadership.
That sounds like a massive turnaround from the early, more controversial days.
It really is. And the analysis views this positive internal culture as a significant, even if it's intangible asset. It's crucial for attracting and keeping the kind of talent they need to run this complex global operation.
But then there are the driver partners.
Yeah, markedly different story there.
They value the flexibility, the earning potential.
They do. That's the draw. But there's also significant frustration, big issues around sudden deactivations, feeling like support is inadequate, often automated chats, and just a general feeling of being, disposable or unprotected.
This two-class system idea the analysis mentions.
Yeah. Exactly. It really highlights the structural tension that's just inherent in their independent contractor model.
That model is key to their scale and asset-light structure.
But it creates constant friction with arguably their most critical stakeholders, the drivers. And it carries ongoing regulatory and reputational risks. It's a really difficult balancing act for management.
Speaking of management, the analysis argues that the quality of the business today is, well, inseparable from the quality of its leadership. Let's dive into that stewardship and the company's financial transformation.
Yeah, Dara Khosrowshahi, CEO since 2017, is definitely positioned as a key figure here. The analysis points to his philosophy, articulated really early on, marking a clear pivot.
Away from that growth at all costs mentality of the previous era.
Exactly. He talked about optimizing for customer happiness, loyalty, being willing to make short-term sacrifices for long-term benefits.
Which sounds like the language of someone trying to build something enduring, not just chase quarterly numbers.
It does. And the analysis finds their capital allocation track record under his leadership seems pretty consistent with that language. They've really shifted from just burning cash on speculative stuff
to strengthening the core business.
Strengthening the core and increasingly returning capital to shareholders.
They're still investing heavily though, right? R&D.
Oh, yeah. Substantial R&D. Around $3 billion a year. Pouring it back into the core, tech mapping, algorithms, payments, even their advertising platform now.
Essential reinvestment.
Absolutely. M&A has also been seemingly strategic, buying Careem in the Middle East, Postmates to bulk up Eats.
But the analysis really singles out one decision.
Yeah.
Selling the Advanced Technologies Group, the AV research arm, back in 2020.
Yeah, that's framed as a pivotal, highly rational move. It fundamentally shifted Uber's AV strategy.
From trying to build the self-driving tech themselves,
which is incredibly expensive and complex,
to focusing on being the indispensable platform, the aggregator, for other companies' AV tech.
Exactly. Let others spend the billions building the cars. Uber wants to be the network they plug into. It dramatically de-risked the balance sheet, allowed them to focus on their core marketplace strengths. The analysis calls it a masterstroke.
And now we've seen that big milestone everyone was watching for returning cash to shareholders.
A huge sign of maturity. That $7 billion share repurchase program authorized in February 2024, and they accelerated it in early 2025.
And the CFO, Prashanth Mahendra-Rajah, was pretty explicit about why.
Yeah, quoted saying he thought the stock was undervalued when they announced it. No dividend yet, but buybacks signal confidence and a clear shift in how they use capital.
Looking at the capital allocation data for FY 22-24, you see that story. R&D steady, CapEx low, M&A strategic, and buybacks suddenly appearing.
It confirms the narrative. Disciplined exits from unprofitable markets, the ATG sale, the pivot to buybacks, these look like the actions of a rational, value-focused team. That rigorous value creation mindset seems evident.
So they've managed to transition from being this, notorious cash burner
to potentially a self-funding compounder.
That's the kind of shift long-term investors really look for.
Exactly. Which brings us neatly to the financial picture itself. Because for years, Uber was just synonymous with staggering losses.
That narrative, according to this analysis, has completely flipped.
It's really one of the biggest findings. They hit their first full year of GAAP operating profit in 2023, $1.1 billion. That accelerated to $2.8 billion in 2024.
GAAP net income can still be a bit volatile because of investments, right?
Yeah, equity investments can swing that around. But the core operational profitability is now undeniable and consistent.
And on the metrics management and investors tend to focus on adjusted EBITDA and free cash flow.
The source basically calls the business a reliable machine now.
Generating serious cash.
Oh, yeah. Q1 2025 alone, they produced $2.3 billion in free cash flow. That really shows the power of the platform once it hits scale and profitability.
The analysis also digs into some key quality ratios, showing increasing efficiency. Let's talk ROIC, return on invested capital.
Right. This tells you how effectively they're deploying capital to generate profit. And Uber's ROIC has seen a, frankly, dramatic transformation.
From what to what?
From a deeply negative 16.3% back in 2020 to a positive 8.2% in FY 2024, and even better, 11.3% on a trailing 12-month basis for Q1 2025.
That's a rapid climb. What does that signify?
It signals really high incremental margins. As revenue grows, it flows more efficiently to the bottom line because the fixed cost base is already largely in place. It shows value creation as they scale.
And free cash flow conversion, turning accounting profit into actual cash.
They excel here now, too. FY 2024, they converted about 70% of net income to free cash flow. Q1 2025 was even better, over 125%. The earnings aren't just on paper. They're backed by real cash.
What about the balance sheet? Any lingering worries there?
Seems much stronger now, provides a margin of safety. They had $6.0 billion in cash and investments at the end of Q1 2025. Total debt around $9.5 billion.
So net debt around $3.5 billion.
Roughly, yeah. And you compare that to their trailing 12-month adjusted EBITDA of about $6.5 billion. That gives you a net debt to adjusted EBITDA ratio of like 1.54x. Very conservative.
So the whole financial profile looks significantly de-risked compared to just a few years ago. Running out of cash is definitely not the story anymore.
Correct. The analysis concludes they're self-funding, profitable, resilient, and showing those key quantitative markers of a high-quality, scaled enterprise.
All right, so we've laid out a business with a seemingly strengthening moat, competent management making rational decisions, and a now pretty fortified financial position. The ultimate question from the analysis then: does the current market price offer an attractive entry point considering all this?
Yeah, that's the million-dollar question, or maybe billion-dollar question here.
Yeah.
As of mid-June 2025, the source notes Uber's trailing PE ratio was sitting around 14.3x.
Price to free cash flow.
Around 22.5x to 23.1x.
Now, you can't really compare that PE to the old days when they weren't making any money, can you?
No, historical PE comparison is useless here. But the trend is what the analysis finds really telling.
What's the trend?
The PE multiple has compressed dramatically. It was over 111x in early 2024, and now it's down in the mid-teens.
Even while the actual business performance, the profits, the cash flow were improving significantly.
Exactly. That divergence is fascinating. The business got better, but the valuation multiple got cheaper.
So what's the crucial judgment from this source, based on their deep dive? Attractive or not?
Based on everything we've discussed, the widening moat in mobility, the platform optionality, the rational management, the financial fortress, their conclusion is that the current valuation appears attractive.
Attractive. Interesting. Why?
Their argument is basically you're looking at a mid-teens trailing PE, maybe low 20s forward PE, for what they see as a dominant market leader with strong network effects and clear runways for future growth. That just doesn't seem overly demanding.
So the price seems to embed a pretty big discount.
Yeah, a significant discount, likely driven by market fear of that future disruption we need to talk about. The source believes the market might be overweighting those risks relative to the current strength and durability.
Okay, so if it's potentially attractive, where does the future growth come from to justify even this price, let alone a higher one?
The primary engine the analysis points to for driving future earnings growth is really deepening that platform ecosystem. And the key tool for that is the Uber One membership program.
Ah, the subscription. Makes sense. Get people locked in, spending more often.
Exactly. Uber One members are incredibly valuable. The source notes they represent less than 20% of users, but account for something like 40% of total bookings.
Wow, that's disproportionate.
Hugely. So it's a powerful lever for increasing user frequency, spending, retention, and ultimately customer lifetime value. It transforms those transactional users into more predictable, recurring subscribers.
But okay, even with all these positives, the analysis doesn't shy away from the risks, the big permanent impairment risks.
No, and it shouldn't. The absolute paramount, you could say existential threat, is autonomous vehicle, AV disintermediation.
Right. We touched on the bull case. Uber becomes the aggregator for AV fleets.
Yes. But the bear case, the nightmare scenario that keeps the market valuation maybe lower than it otherwise would be.
Is that a vertically integrated competitor like a Tesla, or maybe Waymo working directly with a car maker?
Builds its own proprietary ride-hailing network using its AVs and completely bypasses Uber.
Right. And because they eliminate the driver cost, They could potentially offer rides so much cheaper.
That they just shatter Uber's existing network effect. People switch purely on price, making Uber's human driver network a high-cost, stranded asset. That's the fear.
And the second major, always present risk.
Adverse regulatory action, specifically the ongoing risk of being forced by governments to reclassify their independent contractor drivers as employees.
Which would blow up the asset-light model.
Completely. It would introduce massive new costs, wages, benefits, payroll taxes. They'd have to raise prices significantly, which could destroy the value proposition for many users and just hand market share to competitors. The analysis notes this risk has been managed so far, but it's always there and potentially devastating.
Okay, let's try some second-level thinking here. Really challenge the common narrative. What's the analysis say about the prevailing market consensus on Uber right now?
Well, the consensus seems to acknowledge the huge operational turnaround. They see Khosrowshahi has done a good job. They see the profitability, the cash flow is real now.
But there's a big but.
Exactly. That positive view is heavily overshadowed by the fear of AV disruption. The dominant market view seems to be that Uber is fundamentally precarious, maybe even a melting ice cube.
Destined to eventually be disrupted by the tech giants or the car manufacturers who actually control the autonomous technology.
That seems to be the prevailing fear baked into the stock price, yes.
And this is where the source we're looking at presents a really interesting contrarian view.
It does. The core of their contrarian argument is that the market underestimates the enduring power of the aggregator model in a complex future, and simultaneously overestimates the probability of a single, vertically integrated, winner-take-all outcome in autonomous vehicles.
So the market's wrong on both counts, according to this view. Why? What's the reasoning?
Well, first, they argue that future mobility, especially with AVs, is far more likely to be fragmented. You won't just have one type of AV from one company dominating everywhere.
You'll have different providers, different vehicle types, maybe specializing in different areas or use cases.
Exactly. A complex ecosystem, not a monolith. And in that fragmented future, consumers aren't going to want, 10 different apps on their phone to hail different kinds of rides.
They'll want one simple interface.
Yeah.
An aggregator.
Precisely. And the source argues Uber is uniquely positioned to be that indispensable aggregator. They've already got the massive user base, over 170 million monthly actives. They've got the global brand recognition. And crucially, they have deep expertise in managing these complex, real-time, localized networks.
So in this contrarian view, AVs aren't necessarily the death knell for Uber.
They could actually be a catalyst.
How so?
By lowering the underlying cost of transportation, AVs could massively expand Uber's total addressable market, making rides accessible to more people more often. And Uber, as the aggregator, takes its slice.
The Expedia analogy again.
Right. Khosrowshahi's background building Expedia is seen as highly relevant. The playbook isn't about owning the planes or hotels or AVs. It's about owning the customer relationship and providing seamless access to that fragmented supply base.
So the focus should be on who owns the customer interface, not who builds the best self-driving car.
That's the core of the contrarian argument here. And the evidence, they suggest, points to Uber being best placed to own that interface long term.
Okay, let's boil this down then. Based on this analysis, what are the absolute core points of the bull case versus the bear case? Just concisely.
Okay, the bull case. Reasons to be optimistic, maybe own the stock. 1, dominant market position, especially in mobility, with a moat that seems to be widening due to those network effects and cross-platform advantages.
2,
proven, rational, seemingly owner-oriented management that has successfully turned the ship around.
3,
an emerging financial fortress, consistent profits, strong free cash flow generation, solid balance sheet.
and 4, the big one.
The argument that Uber is ideally positioned to be the essential aggregator for a fragmented autonomous future, potentially expanding its market.
Okay, now the bear case, the counter thesis, the reasons for caution.
1, the existential threat. Vertically integrated competitors using AVs to achieve a step-change cost advantage and bypass Uber completely.
2,
Intense, ongoing competition in both rides and delivery, which could limit pricing power.
3,
That permanent, potentially catastrophic regulatory risk driver reclassification.
and 4.
Just the underlying concern that the service is fundamentally a commodity, and maybe those network effects aren't strong enough to prevent commoditization or disruption long term.
All right, finally, let's really stress test this. Let's put on the red team hats like the source does. What's the single strongest challenge to that optimistic bull case, specifically the aggregator premise?
Yeah, this is crucial. The Red Team Challenge directly attacks why that Expedia or Amazon aggregator analogy might just be flawed, why it might break down for Uber in an AV world.
Okay, why might it be different this time?
Because the cost reduction from full autonomy isn't incremental. It's potentially a step change. Removing the driver might make trips, 30%, 40%, maybe even 50% cheaper.
That's a huge difference.
Exactly. And the argument is that that magnitude of price difference is powerful enough to completely shatter existing network effects.
Because saving 40% on every ride makes downloading a new app seem trivial. Loyalty goes out the window.
Precisely. The source uses the specific example, what if Tesla launches its robotaxi network? They have a huge existing fleet, massive brand loyalty, direct customer relationships through their cars already.
They could potentially launch a significantly cheaper exclusive network.
And achieve critical mass incredibly rapidly, just pulling users over purely on that dramatic price difference.
And in that world, Uber's current massive network of human drivers becomes, what? A liability?
A high-cost legacy liability they're stuck with. Partnerships with other, maybe smaller AV players might not be enough to compete with an ultra-low-cost, vertically integrated giant who owns the tech and the customer.
Uber gets forced into a price war. It can't win because its fundamental cost structure is higher.
That's the scenario, like the taxi companies they themselves disrupted. Yeah, that's the fear articulated by the Red Team Challenge. That's how Uber, despite its current success, could potentially become a value trap. Its current earning power faces this risk of permanent, irreversible decline if its platform becomes a sort of stranded asset against a fundamentally lower-cost future competitor.
Wow. Okay, we have really taken a deep dive into this analysis of Uber today. We've explored its transformed business, the dynamics of its moat, the sentiment from customers and drivers,
the key decisions of its management team, and the surprising strength of its current financial profile.
So hopefully you listening now have a much clearer understanding of the key dynamics, the core arguments, and the fundamental debates that are swirling around this company, at least according to this specific analysis.
Yeah, the company's current performance, the operational improvements, they're significant. They're real.
But they are undeniably set against these very real, potentially very powerful long-term risks. Most notably, that profound uncertainty around the future of autonomous transport and regulation.
It paints a fascinating picture, doesn't it? A company that's navigated huge challenges to finally reach consistent profitability, but still faces these potentially game-changing technological shifts just over the horizon.
So here's maybe a final thought, building on this analysis for you to ponder.
Yeah.
Is the market's deep-seated fear of AV disruption really warranted? Is Uber destined to be the next taxi industry disrupted by new technology?
Or is the market missing Uber's potential to leverage its network, its brand, its users, to actually become the indispensable operating system, that crucial connection layer for all kinds of movement in what's likely to be a very complex, very fragmented future?
What stands out to you from this deep dive?